Hey, dividend growth investors. I hope that you are doing well. Today, I'm doing a different kind of video, a little bit more about just me telling you about my thought process. Why? Because a famous, well, no, not famous, but well-known financial planner, Ed Rempel, made a video last week or 2 weeks ago about dividend investing being a brain fart. And then I got submerged by a lot of emails by people saying, hey, have I been investing in dividend stocks for nothing for the past 20 years? Like, what's going on? I'm confused. And I guess a lot of people expected me to do a video that would completely debunk what Ed is saying in his, but you're going to be disappointed because actually Ed is right about a lot of things, and there are big problems with dividend investing. So we're going to talk about that today. He also forgot a lot of things too. So we're also going to tell you the full circle about dividend investing. And then at the end of this video, I'm going to tell you a little bit more about what is my philosophy and why what Ed said overall doesn't really matter when I focus on my own investing strategy. So let's get started with something that should be obvious for everybody is selling shares, dividend payments comes to the same thing. A dividend payment is not magic. And Ed does a very good job at explaining that in his video with numbers. But here's a picture for you to help. Imagine that you come to buy my house, and my house is for sale at $500,000, which is more than the market is expected, like the average market. But when you visit the house, you realize that there's a safe inside my house, and there's $100,000 in cash in it. And I tell you, well, that's part of the house. It's not leaving the house. So then you're telling yourself, well, I'm buying the house for $500,000, but really I pay it for $400 because there's $100,000 in cash sitting in the house, right? So you may want to buy the house. 2 weeks later, you move in, and then you realize that there is no $100,000 in the safe anymore. So how do you feel about your purchase that you bought $500,000? You're probably going to call me and say, well, Mike, that was not the deal. I bought the house at 500 plus there was $100,000 in the safe. And then I would tell you, oh, but I gave it to my son, kind of like a dividend payment. But it's all good. You still have the house, still the same house. There's nothing has changed, right? And then you would be incredibly upset because that $100,000 is gone. So the value of the house obviously decreased. And it's exactly the same thing when a company is emptying its bank account to pay you as a shareholder. There's no magic here. It's just like money going from one pocket to the other pocket, but it's still the same money. And the stock price, the value of the company will decrease accordingly. So if you don't get it with the math, you may get it with the example with the house, where you're not going to pay the same price if there's $100,000 inside a safe or if the safe is empty. So the second thing that I really agree with Ed is the dividend yield doesn't matter. And that's true because, again, if you look at high yielders, most of the time, those are mature businesses that lack of growth. And at one point, they just use good old Finance 101, where the company doesn't know what to do with their profit, with their money. And instead of destroying value, they decide to give it back to shareholders. So if there's no other projects, no acquisitions, no R&Ds that they can invest in to generate more value for shareholders, well, financial literature says, well, you might as well just give it back to shareholders so they can allocate that money elsewhere. So when you think about it, do you really want all high yielders in your portfolio? I just told you that they don't know what to do with their money. And on top of that, they lack of growth. So the yield doesn't matter when you invest, and you should be agnostic versus like a low yield, a high yield, or technically no yield at all. But I'm going to go back to that point later on in this video because I think there are a few things that we have to add on that. But the dividend is not magic. The yield doesn't matter. Those are two things that I agree with Ed. Not too long ago, I did a video about Bell and then about Delis, explaining how the cash flow works and if to see if the dividend is safe or not. And someone said, well, you're overthinking. He put that in the comment. You're overthinking and just enjoy the dividend. And I'm like, you know what? Probably that a lot of shareholders of AT&T thought the same thing. And today they're not super happy about the result. So you cannot take that for granted. A dividend payment is not free money, and a dividend payment is definitely not guaranteed. To be honest, management will cut the dividend to save the business way before they think about your retirement. And this is something you should not forget. And the last point Ed and I agree on is the tax efficiency. Capital gains are better than dividend in a non-registered account. So if it's a fully taxable account, that totally makes sense that you would prefer no dividend or low yield to a high yielder. You're going to pay more taxes on a dividend that you may reinvest, but you're going to pay dividend right away. As for the capital growth, it's just going to grow forever until you sell your shares, and then you will trigger the tax to be paid. So that is a major difference. So to summarize, I agree with Ed that dividends are no magic, the dividend yield doesn't matter, and there is tax efficiency in a non-registered account. So Ed's video was okay, but he forgot about a few things. One of them is he keeps talking about the tax impact as it was a major thing. But I mean, when you think about that, you probably have a pension account, you probably have like maybe a LIRA or RRSP or TFSAs, and all of those accounts are tax sheltered. So of course, you may eventually get to having a non-registered account where you're going to pay tax on it. But if you're a Canadian just like me, probably that the big important part of your retirement will all be tax-free when it comes to grow the investment. So in other words, it doesn't really matter if the taxes on the dividend is important or not, because it grows inside an RSP or a LIRA account or a TFSA, and then you don't even have to worry about a tax. The second thing he forgot to mention or go a little bit deeper is the fees. Because he suggested a few times, we deal with portfolio managers that are managing and they're not focusing on dividend, but he forgot to discuss the fees. And the fees are pretty important, as much as the taxes actually. Because when you're paying like 2% fees and you would have generated 8%, you're going to say, it's only 2% fees, but it's actually 25% of your returns that you give away. So yes, it's 2%, but it's a quarter of the returns you should have made. And that's at 2%. Obviously, 2% mutual funds, probably. If you go with a financial advisor that is doing a little bit better job, he's going to charge you maybe like 1%, 1.5%, especially in Canada. But still, we're talking about more than 10% of your returns that you give away on 8% return over the long run. Because obviously, some years you're going to make more, some years you're going to make less. You should not even plan for 8%. You should plan for like 6.5, maybe 7% if you're all in equities. If you have bonds, then it reduces to maybe like 4.5, 5% expected return. So if you pay a 1% fee, you are going back to that 20, 25% of returns you're giving away to your advisor. And I think this is a big chunk. Now, I'm not against financial advisors. I've been a financial advisors in the past, and they provide a lot of value. Some of them, actually, not all of them, obviously. So if you get a lot of value, if you don't have the time, the knowledge, or the interest to manage your portfolio, you're better off with a financial advisor, because he's not going to make the mistakes that you will do, let your emotions goes in. So there is added value to deal with a financial advisor. You just have to make sure that it's the right decision for you. Speaking of emotional control, one thing that I believe that dividend growth investing is great at is to get your emotion in check. And you don't have to pay 1 to 2% in fees to an advisor to do that. Why? Well, when the market goes down, I don't really look at my portfolio value. What I do look at the dividend growth. So the dividend payments that has been paid over the past few months versus last year. And when they are up, that tells me something. It tells me that the businesses that I have in my portfolio are doing well. They're not doing well, they're doing incredibly well because they do not only pay the dividend, but they actually find a way to increase it, telling me that yes, we may be in the middle of a market crash. Maybe there's a recession. Maybe there's a mortgage crisis. Maybe there's too much inflation. But as a business, we still make profit, and we believe that we're going to make more profit in the future, and therefore we can afford to increase our dividend payment. So one of the main advantages of dividend growth investing is to help you rationalize your emotions and get back to your plan, get back to your strategy, understanding that when a business increases its dividend, it doesn't really matter what's happening on the market because the company is sending you a big message. It's like writing you a note, say, hey, Mike, don't you worry about the stock price right now. Our business is still very healthy and we're going to continue to thrive in the future. We know the numbers are not good this year, but better stuff is coming up. So that is the signal. As you can see, I do focus on dividend growth investing. So I do agree with Ed that if you just focus on dividend investing, you're making a big mistake. If you're focusing on yield, you're making even a major mistake. And for that, I will leave that in the comment section or in the show note for the podcast episode. You can download the Dividend Income for Life guide where I explain my philosophy, my strategy, where I focus on low yield, high growth stocks. And the main focus is all about dividend growers instead of going after dividend high yielders. And in fact, the high yielders are actually probably the less safest place on earth to invest because most of them will not increase their dividend or even worse, cut it off, leaving you with less buying power and less capital to pursue your retirement dreams. You don't want that, right? So download my guide in the show note, Dividend Income for Life. Now, I told you that at this end of the video, I would tell you what really works and what I believe in, and it's really dividend growth investing. When you think about that, I don't focus on the dividend payment because what I want to see is a growing dividend payment, because the growing dividend payment will be the result of finding a business that is thriving. When you think about that, what's the purpose of investing? The purpose of investing is to buy shares of companies that will do well in the future, that will generate more profit, create more value, so you get more money that you have invested, right? That's the like at the very basic point is whenever you put $1 in, you want to be able to get more than that dollar back at retirement or for any other projects. So if I tell you that there is a way to monitor companies to see the results where when they are able to grow their sales, maintain healthy margin, have a robust balance sheet, finding more growth vectors, maybe through acquisition and even making more profit after that, well, there's a way to monitor those results, and it's called the dividend payment. If the dividend payment increases every year, you automatically have a business that is at the minimum believing it's going to grow. And technically, they will not be able to grow their dividend for many, many years in a row if they are failing to grow the business, right? So a long-time dividend growers is a proof that a business can grow through a recession or any market crisis, and it can also find ways to increase revenue and increase profit. So as an investor, this is exactly what you want in your portfolio, thriving businesses. This is what dividend growth investing is about selecting those companies with providing you another additional set of metrics that you can track. Because of course, a company like Tesla or Meta are doing very well in the stock market for a few years. But the problem is I cannot really track their dividends. So I'm lacking of financial information. It is sometimes easier for some people to do that, but in my opinion, with my strategy, I like to keep it simple, and having the dividend will enable me to do a better monitoring of those stocks and also making sure that those companies are heading towards the right direction. From a company's point of view, the dividend payment is pretty much like a debt. So it's a debt that they could cut without affecting their business. That's even worse for investors because it is the first thing that they're going to cut, right? They're not going to call their banker and say, Well, you know what, Mr. Banker? I'm not going to pay my loan today, but I'm going to distribute money to my shareholders. They're going to do the opposite, right? So you want to find dividend growers. Last but not the least, I often hear that if you select dividend payers, you actually lack of diversification in a sense that you are ignoring a large part of the market. So the last part is true. You are ignoring a large part of the market. However, you do not lack of diversification. You're just a little bit pickier. So you will select the best fruit from the best basket. I would say that it is sound investing strategy instead of saying, oh, I'm lacking of diversification. Actually, you can find great companies paying increasing dividend in all sectors, both in Canada and both in the US. And when I look at my sector allocation, I found it quite diversified. I'm easily able to find 20, 30, if I could even put 40 or 50 stocks in my portfolio. I won't go there because at that point, you're better off with an ETF. But I can definitely manage a portfolio of like 30 something stocks that are diversified across the 11 sectors and in several sub industries where my portfolio will not be majorly exposed to a specific risk or a specific sector and still be able to generate strong returns. So what really works for me is that belief. And that has been proven many, many times where dividend initiators and dividend growers tend to outperform the market. And when you think about that, it's only normal because those businesses, to increase their dividend every single year, must make more sales and must make more profit. So by following this simple strategy of, oh, the company didn't increase its dividend last year, it's going to be a red flag and eventually it's going to sell. I'm going to sell it. And now I'm going to focus on those that keep their promise alive every single year. In the end, regardless if you decide to go with head strategy and decide to just sell shares to create your own dividend or create a mix, like as I suggest in my dividend income for life guide, where you do a mix of dividend payment plus selling shares, or if you just go all in one in ETFs, that's all good. The point here is to take a good time to reflect on the strategy you want, depending on your goal and on your financial situation and what you believe is true. Because when you're confident in a strategy, that is what matters the most. I worked as a financial planner for more than 10 years. And in 2007, a lot of people were saying, oh, we're going to invest into this or into that. Like it was like big thing on emerging markets. And then 2008 crisis happened. And then everybody said, oh, sell emerging markets. They're crap. Now let's go back to gold. And then gold eventually dropped down. And then the oil was popular. The US market was popular. Sometimes was the European market or whatever. But in the end, those people were not confident. They were just chasing money. They were jumping from one strategy to another because they let the noise like brought them like from one place to another without really thinking about what they want and what they're doing. For that reason, I decided to focus on a single and simple strategy that works for me. Maybe it's not the right one for you, and that's okay. There are plenty ways to reach your goal. The key here is to make sure you find the one that suits you. All right, guys, that's enough for today. And I'm going to be back next week with another video where I'm going to discuss all the trades I made for 2024. So don't forget to stay tuned and stay invested.